All right, everyone, welcome back to the Nadlan Forum Podcast Daily. It's Ruby here, and I'm joined by Lior. I gotta say, today's episode is shaping up to be a cracker because the Fed's been dropping hints about ending its balance sheet reductions and possibly even, wait for it, rate cuts. Leah, did you catch Powell's speech at NABE?
Yeah, I did. And honestly, I think it's an important moment. You know, Powell made it pretty clear. The Fed is approaching the end of this balance sheet runoff, which is really about quantitative tightening. For people not following all the jargon, Ruby, you want to explain what that is?
Yeah, sure, let's keep it simple. So, quantitative tightening is really just the Fed letting some of those trillions of dollars in treasuries and mortgage-backed securities they bought during the pandemic, letting them slowly roll off instead of buying new ones. Imagine cleaning out a closet, but only tossing out a few things at a time so you don't make a mess. They're basically draining some liquidity out of the financial system in a measured way.
Right, and Powell made it pretty clear. They're almost at this ample reserves point. It's not going all the way back to pre-pandemic, so we're not seeing a $4 trillion balance sheet again. It'll stay higher. More like a post-pandemic normal, I guess.
And they're keeping a close eye on liquidity, right? Nobody wants to spook the markets or accidentally lock up credit. I've seen how this kind of move plays out in Australia, actually. The last time our Reserve Bank did something like this, it rattled property markets for a while. Loans got tighter, buyers got nervous, and investors slowed down. Totally different landscape here, though, Lior, because US mortgage markets are, just bigger and messier, honestly.
Yeah, and here, any little shift in how much cash is sloshing around can have huge effects. We saw mortgage-backed securities pile up on the Fed's books since 2020. And now, with runoff slowing or pausing, it's going to send signals to banks and investors that maybe risk is lower or at least more predictable. Where was I? So real estate pros, especially in the US, watch these Fed moves like hawks because the cost and availability of credit really does impact everything.
So while Powell's saying, hey, we might stop the runoff soon, everyone's sort of side-eyeing, wondering, what about rates? Because let's be real, the big question for investors and homeowners is always, are rates going up or down? And the Fed's kind of stuck between a rock and a hard place, right?
Exactly. They've got this balancing act, managing inflation that's still above target while also watching as the labor market softens. Powell even said the risks on jobs and inflation are finally a bit more balanced now, which is rare. But if they move too fast with cuts, inflation could flare up. Too slow, and more people could lose jobs.
Yeah, and you know what's wild? The labour market's still kind of sturdy, but not as sturdy as before. Slower job growth, some softness, and yet inflation's refusing to get the memo and drop back to 2%. Powell's trying not to spook anyone, but also making it clear we're not out of the woods.
Yeah, rates are still a tool. And if things get bumpier, like much softer employment or a sudden demand drop, they can cut. I've seen it up close here in New York. The second rates budge, it's like the entire mortgage industry shifts gears. In the startup world, especially with real estate tech and financing, funding deals can go from hot to cold overnight, just on rates rumors. The availability of mortgages changes so much with just small policy signals.
And if you've been listening to us, you know we talked about this in our episode about mortgage rate stability. When economic data's shaky, rates might stay low, but don't expect it to last forever. Honestly, I'd say watch the Fed's next moves if you're thinking about locking in a loan or refinancing, because the window for low rates could close fast if inflation becomes more stubborn.
Yeah, and the takeaway is nobody will ever be able to perfectly time the market. So you gotta pay attention to where employment and inflation are heading, but also don't overthink it. Make decisions based on your local market and own needs.
All right, let's talk about the elephant in the room, the government shutdown. I reckon it's like trying to drive with half your dashboard blacked out. Powell himself said they're flying a bit blind, right? So much of the data, payrolls, retail sales, delayed or missing entirely. Lior, how do you reckon real estate professionals deal with this kind of uncertainty?
Yeah, it really becomes, well, let's say you need good instincts and lots of patience. When key stats are missing, everyone's guessing what the Fed will do next, including mortgage brokers and lenders. The upcoming CPI report is the one thing everyone's pinning hopes on. Kinda like checking the weather when you're planning an open house, I guess.
Totally. It's like checking last week's weather report and hoping it still applies. But seriously, Lior, is there a trick, some way you keep ahead when all you've got is old data?
It's never perfect. Sometimes you just got to rely on what clients and local agents are feeling on the ground. We try to read between the lines, look for what's moving, inventory, offers, anything really. But I'll say this, for investors, it's more important than ever to stay flexible. We talked last episode about why USDA loans froze up during shutdowns. Classic result of missing data causing chaos. So we always need a plan B.
Love it. Plan B, Plan C, and a well-stocked coffee cabinet. All right, that's going to do it for today's episode. If you're following all this Fed news and feeling a bit seasick, don't stress. We'll be back soon to break down what those new CPI numbers mean for your rates and real estate deals. Lior, thanks for surviving another wild news cycle with me.
Of course, Ruby. Was a pleasure, as always. And to our listeners, stay sharp, take care of your timeline, and we'll catch you next time here at Nadlan Forum Podcast Daily. Take care, Ruby.
Cheers, Lior, and cheers to all of you tuning in. See you next time.